here on set. Now for a look at the 2026 M&A outlook, let's bring in the voice of Effram Kaplan. He's co-chief executive officer at Brown Gibbons Lang and Company. Effram, talk to us a bit about how you would reflect on this year, 2025, in terms of deal-making activity. Is there anything else that you would have preferred to see more of?
Nora, Vani, Happy New Year, early Happy New Year to you both. Thanks for having me. 2025, frankly, turned out to be a much better year than we anticipated. Obviously, that's a huge positive, and we think that'll sort of lead into 2026. But, heading into the year of 2025 was similar to what we saw the past few years, which was a bit of a muddy water scenario. The macro economy had variables that weren't so easily understood. There was volatility. You saw VIX up and down. 2025, the VIX is ending the year at near 5-year lows. And so would we have liked to see more exposure to broader exposure to more sectors? Yes. Would we like to see more exposure into the lower end of the market from a deal size perspective? Yes. But suffice it to say, 25 was a fantastic year, and we saw, frankly, an uptick in deal volume, and we saw a lot of value being created at the large end of the market, sort of $2.5 billion EVs.
Mm-hmm. Yeah, I mean, it's really interesting as we're really just parsing through what 2025 has looked like. But moving ahead to next year, what's a single factor that you think will really determine whether or not M&A activity actually accelerates in 2026? Is it rates that we're keeping an eye on, valuations, or is it more or less just confidence?
Yeah, I don't want to sound cliche, but the clarity that we're seeing is absolutely a major driver. I do think there are structural components to the market, and there is strategic positioning happening based on the AI trade that y'all have talked about. But let's face it, if we look at where inflation has been trending over the past, call it 9 months or 8 months, it's flatlined, which, yes, is it where we want it to be? No. But does it provide clarity to price assets? Yes. When we look at the rate environment is much more dovish now than it had been for the prior, quite a while. And so clarity is a recipe for improving how you can price assets, and we're seeing that. But make no mistake, there are other aspects.
You're a little bit more confident than those on the FOMC committee there, Effram. I think that there wouldn't be so many dissents if there was so much clarity, would there?
No. Let's see what the FOMC looks like in a little bit.
Second half of next year.
Yeah.
Well, let me ask you about your area, because you head up the environmental services, environmental infrastructure, and energy transition business at your firm. What does that look like these days, given that the Trump administration is not too interested in the energy transition? Does it mean that there are companies that are consolidating, that are doing lots of deals, that are shifting what they look like to the outside world? Tell us about that.
Yeah, I think it depends on how you define energy transition. So energy transition just means we need more energy. And so there will be a broader usage of variable inputs to...
Well, no, I mean, I understood it to be a transition to cleaner energy and to
Correct.
More... Yeah?
Yeah, I do think there will be more variables coming in from a power perspective. But with that said, what's been interesting from an environmental perspective, and frankly, broadly speaking, within the capital markets, is we've seen this massive influx of capital coming in to the private markets from an infrastructure point of view. And so you mentioned environmental, you mentioned the changing infrastructure we have here in the U.S. And so infrastructure funds now take up, call it 14-15% of total capital, where if you looked about a decade ago, it was in the low single digits. And so there is a massive build out in infrastructure, which we're excited about over the long term rather than the short term in 26. So infrastructure, there is building within the U.S. infrastructure. There will be ancillary sectors that benefit from that beyond just services and infrastructure, which we saw in 25.
Interesting. So let's talk a bit about the cash that's going to be put to work when we think about the deals for next year. Are all cash deals becoming more common, or is leverage coming back at all?
No, another great question. This is if you think about, as I mentioned, market structure, one of the issues we've seen over the past, call it 4 years, especially in the private markets, not the public markets, is liquidity. And of course, everybody wants all cash deals. But given this issue in terms of asset pricing because of the lack of clarity, we've had creative structures come into the market, especially again in the private market. And so we have seen more preferred transactions. We have seen secondary transactions. We have seen continuation vehicles in the secondary market, which frankly provide liquidity to the LPs, but not necessarily the GPs within the private equity funds. And so all cash deals are definitely a preference, but we are seeing many different structures take place which don't provide all cash to incumbent shareholders, but to more passive shareholders. And so clearly that's an indication that the GPs and the owners of these businesses are bullish about the future.
Yeah, I mean, I had thought that the environment was difficult for LPs and GPs. I mean, are you seeing any, I don't want to say fire sales, but are you seeing sort of anyone get so impatient that they just want a deal done at any price?
Yeah, I don't want to sound like a contrarian, but I just don't see that as the case. I see, if anything, the LP market getting more patient because of the proliferation of product. And now, again, I'm bifurcating between public and private. Of course, in the private market, shareholders are getting impatient. You see actually more activism within companies looking to either take these businesses private or monetize their assets more. In the private markets, I actually see something quite different. Again, secondary vehicles are somewhat nascent in the private market, especially sub $2.5 billion of EV and below. And as long as these LPs are getting liquidity, not necessarily outright sales, they're content. They're buying into the GP strategies. They're buying into where these GPs are building these businesses. And so, again, these different types of products are providing more liquidity, not outright sales, and it's becoming a longer-term market. So the other aspect that I'll mention, not to elongate the answer, is you've seen hold periods of private equity firms get to 4 years or so on average. Historically, you'd have average, you want portfolio, you want investments to last 5 years or so, and average hold periods would be 2.5 years. Right now, average hold periods, I think, are going to extend and become more of the norm on the 4-year, 5-year time frame because, again, these GPs are extending. As long as they can provide liquidity, then they're going to extend those asset hold periods.
All right, Effram, pleasure to speak with you and to get an insight there into the deal market. That is Effram Kaplan, Co-Chief Executive Officer at Brown, Gibbons, Lang and Company.